Traders, what is mean reversion? What can it tell us about market cycles? That's what we're going to talk about in this episode, number 20 of the Independent Quant podcast. I'm the host and founder of the Independent Quant, Luis. I help traders turn their trading ideas into algorithmic strategies. Now, I'm a trader just like you. I'm not a financial professional. I don't represent any institution. I only represent myself and the Independent Quant. Everything that I talk about on this podcast is for educational purposes only. I make no recommendations on strategies, products, or anything that affects your trading. All trades you trade are your own. So with that, let's dive into what are we going to talk about here on mean reversion. So we're going to understand what mean reversion is, what mean reversion relates to the market cycles, and how traders use mean reversion in their strategies. So what is this mean reversion? So it's a concept that says that prices return, well, not just prices, but also returns tend to move back to their long-term average. So there's two ways it can do that. Either it can snap back aggressively to that average, or it can kind of go sideways until the average comes to it. Usually the one that we're more focused on is the one where it actively moves back towards the average. And this comes from the concept of why do prices even move in a market economy? And a lot of that has to do with overreactions, and corrections, reversion to equilibrium. If you've studied economics, as I have for an undergrad, you understand that there's in a market economy, both buyers and sellers are actively trying to find the price that they're going to trade at. And that price is a pursuit to get to equilibrium. Even in trading, that is happening too. We are trying to capitalize on these movements, but sometimes those prices tend to move beyond what one side or the other would agree to buy or sell at, and it causes those prices to revert back. So sellers may be selling too high, too fast. Well, they're not going to find buyers all the way up there. So they're going to have to wait or come down on their price until buyers come back out and start buying. In a very nutshell is what mean reversion is. How can we use mean reversion, or how do we see it? A lot of traders use indicators for that. Moving averages, I think, is the go-to one. That is visually easy to see, and it kind of drives the point that things revert back to the mean, right? A moving average is a mean. So long-term improved moving averages give us that baseline of where we can see price could potentially revert back to. Right on the heels of moving averages, though, are Bollinger Bands. Bollinger Bands are, I think, when I talk to someone on mean reversion, where their mind goes to, I was taught to use Bollinger Bands as well. And what are Bollinger Bands? A Bollinger Band has a moving average associated with it, but then it has these other bands on either side, above and below the moving average, that are certain standard deviations away, typically 2 standard deviations. There are traders that add to that. I was taught to add a 3 standard deviation bands to my Bollinger Bands. And what that helps us do is know how extreme is this price movement. From statistics, we know that 68% of the data is within 1 standard deviation. So roughly 68%. It's a 68 point something for those of you that are going to call me out because I'm not as precise as I should be. But a large percentage of the data falls within that standard deviation. And in our case, it's for the Bollinger Bands, it's looking at the close price of the time frame that you're looking at. So when we see price go beyond the Bollinger Band and close outside of that, we can anticipate that if it comes back into the Bollinger Band, it's going to travel back to the moving average, which is the middle line inside the Bollinger Band indicator. So I think Bollinger Bands are the standard for a lot of people that use mean reversion trading. So it's a mainstay here. The last two here, for my experience and at least in my community, it's not something that I've touched on. I do see some people use it, but it's not really my niche. Is relative strength index, which is an indicator that usually shows up at the bottom of a chart when you add it to your chart. And the way that traders use that is to kind of find overbought and oversold. They establish what value is going to be deemed overbought. let's say that value is 70, the numbers in a RSI can go from 0 to 100. When it's oversold, then that line will drop down to a value below 30. And those are conditions that they anticipate. If has a high reading, then they're looking to short the market. If it's oversold and it's got a low number, then they're looking to go long on the market. The indicator in of itself, from my experience, has never been the exclusive trigger for traders to trade a mean reversion strategy, but it is a tool that's used for mean reversion. And this last one here, I'd say more for thoroughness, but it's not really something that we as technical analysts or quantitative traders tend to use. But I guess you could, because it is a data point, and that's price to earnings ratio. Usually somebody that's more a fundamental analyst is looking at this type of figure. And I say that because usually this information isn't available on a chart or a trading platform. It's a number that's usually available off the market by some type of analyst output. But how it helps us is when the price earnings ratio is really high, especially for the company or the instrument that we're looking at, or when it's compared to the industry, you can say, hey, this is probably going to revert back. The price to earning ratio, this stock is trading far beyond what its earnings really justify. So the price is going to have to come down. Vice versa too, if it's trading too low. Won't really get into too much on pricing earning ratio here, just because again, it's usually not a technical analyst tool. And I know this is the Independent Quant. We're talking about quantitative strategies, but if you've been following me along, I am a technical analyst that is migrating to become a quantitative trader. So it's just not in my toolbox. So mean reversion and market cycles. So no surprise, markets don't move neatly in any one direction. They're very choppy. Even when they're overall, the trend line may be going up, it does so in gyrations on its way up, and the same thing going back down. We can help identify market tops and bottoms using mean reversion, using, again, the RSI for those that find that really valuable, or gauging how far price is above a long-term moving average. Sometimes you use multiple moving averages and not just a single one to kind of determine if price is getting extended. You can see that if you have a lower valued moving average compared to something like a 100-day moving average, the larger one moves significantly slower than the faster one does as far as reacting to price movements. But you can see that hyperextension, and usually even if you take your candles off your chart and just put moving averages on there of different values, you can see this dynamic of price coming back in. With that, we can usually see the tops of markets happening using both moving averages, the RSI, and trying to gauge how price action is moving overall, given past historically. Using that same type thinking, only inverting it, we can use mean reversion to spot the bottoms and know, hey, this is going to be our lower risk area or low risk time to jump in the market and go long it, because again, either RSI is below 30, or you've got the moving averages, price extend well past the moving averages or below the moving averages. So these are good indications to kind of say there might be a condition here for us to trade. So how do we as traders use mean reversion? So I have this book here called Mean Reversion Trading by Nishant Pant, and I'm not endorsing this book at all. I bought this book a couple years ago with only the intent to actually trade this with an algorithm. I'm an options trader, and this is using option spreads and technical analysis. Technical analysis is what I've been doing for the last 10 years. But I said, this is pretty cool. It's more or less where my mind is today as I'm transitioning over to being a quant. But we can use strategies like these, and there's many of them out there. This gentleman has this one. Again, I have not traded this strategy myself. My goal with this book is to code it, right? And trade the code, the algorithm that I develop with it. But so that's one way that we can use this. It's buying those undervalued stocks. It's understanding, as traders, we want to understand when we can get into a trade and when we have to get out of a trade. And mean reversion provides the tools to be able to do that. So it's a very powerful tool, to use in our trading. It helps us understand that markets move in cycles. This is looking usually a lot more detailed than something like Elliott wave theory that's looking at these big impulses and corrections. Usually the scope of a mean reversion strategy, depending on the time frame you're looking at, right? This you can be looking at mean reversion on a monthly or a daily, and that's going to span several days to several weeks. But there's usually a sweet spot in there where you can see what the market cycles are and what you can do about it. So if you found value in that, thank you so much for tuning in. Head on over to the Independent Quant, sign up for our newsletter. As I record this, I'm doing a big migration from the site from one location to another. So some resources are going to be enhanced. And now is a great time to head on over to the Independent Quant and see what I'm up to over there. But until the next time, traders, keep it green.